Good afternoon, everyone, and thank you for joining us for our monthly international strategy call for May 2023. My name is Raj Patel, and I'm the Chief Equity Strategist at Itaú. I'm joined by our moderator, Marcelo Olson, who is the Head of Global Markets and Strategy. We wanted to update everyone on the ongoing debt ceiling negotiations, since it could have some short-term impact to markets, but also longer-term consequences for fiscal spending and monetary policy. It's currently in the news a lot, since we either need to have some type of deal in principle by the end of this week, or they need to agree on an extension. We invited Alejandro Estevez-Breton and Gina Baccelli to lend us a hand with their expertise on this topic. I'd like to pass it on to Marcelo.
Thank you very much, Raj, as usual. I'm going to switch to Portuguese for a second. Antes de começar, bem-vindo a todos. Obrigado,
Before
Gina,
we start, welcome everyone. Thank you, Gina and Alejandro, for your presence. I'd like to highlight that we have simultaneous interpreting both ways, English and Portuguese, and you can click on the bottom part of your screen and choose the language. We will have the live in both languages, but the channel you have selected is the one you'll be listening to the translation. So Raj made the introduction, and we are going to talk about debt ceiling, the American debt limit. We've been discussing a lot, not only on economic impacts, but also portfolio positioning, but it's also part of our scenario for the long run, the medium run, and how this can bring an impact on tax discussions in the US, the impact over dollar, and all the impacts of monetary policy. So first, I would like to thank Alejandro, our Chief of Fixed Income Strategy. He's working on grades, interest rates, when we talk to clients, and so on. And you all have met Gina. She's been present many times in our updates. She's working very close to us as Chief Economist of Private Bank.
So, Alejandro, I would like to start with you. Maybe we can kick off by explaining what is the debt ceiling. I'm sure that people are reading about it in the news, but at least to go over some of the details and where we stand right now. It feels like every week you have some sort of development in this, let's call it soap opera, but there's also a lot of impacts and uncertainty around it. So again, thank you for joining us. If you can give us your 2 cents.
Thank you, Marcelo, for inviting me, and thanks to all the clients that are joining us. Hopefully this is going to be useful for you. So I'll try to be brief. I think there's maybe 3 to 4 things that I want to share. First, the what. Second, the why. Third, the when. And finally, the if. If it happens, what could we see? So the what, I mean, is fairly simple. The debt ceiling is the authority for the government to issue new debt. So this is separate from the authorization to spend, let's say, on whatever spending, Social Security. I mean, that has already been approved. So once the spending has been approved, you need to issue debt whenever there's a fiscal deficit to be able to finance that. And this is what's at stake at this point. So it's not about spending, although it is related to spending, because let's say the negotiation could be related to spending cuts. That's probably Gina might discuss later. So what's happened is the National Treasury has reached the limit to issue debt. So it has to kind of basically implement some emergency measures to be able to continue operating without issuing the excess debt. I guess the question at this point is, can the debt limit be raised before the government runs out of money? So technically, the government is running out of money. I mean, it had more than $1 trillion a few months ago. Now it has essentially between 50 and 80 billion. So it's running out of money, literally. If not, there could be a technical default. A full-blown default is unlikely, but a technical default where there's maybe a few days of one specific bill, treasury bill that hasn't been paid could happen. So we'll talk a little bit more about that later. So the essence here is that maybe the government could fail to pay some of its obligations in a technical default fashion, which is very specific. 1 or 2 treasury bills might not get paid, maybe, very, very specific and very short-term situation, right? The why I would say it's a very polarized political environment, right? And we've seen that basically both parties have extreme factions, and it seems that the debt ceiling is a good tool to extract concessions from the governing party. This is not new. This has been happening for the last 30 to 40 years. I think the difference right now is the political polarization is even more pronounced than it was in the last 30 years, and that the majority that both the president, the Senate, and the House have is very tight. So essentially what you have is a divided government where president is Democrat and the Senate is also Democratic, but it's very tight. And the House is barely a majority of the Republican side. So this is where the situation is playing real drama, right? Which is the House. The Senate is not playing a very important role. Here the question is when. So the forecasts have been around June to July. Some of them were August, but I think we're running more towards June because we're seeing that the government's running out of money, really. You can see it in real time. There's the cash position of the Treasury at the Fed, and that's running lower and lower every week. The second thing is the tax receipts, or basically what the government has been able to raise as tax collections has been lower than expected. So those things are basically indicating that what the Treasury Secretary Yellen has been basically telegraphing is that June 1st is probably the X date, which is the date where the government could run out of money. There's a bit of uncertainty around that depending on the assumptions and tax collections. But most of the, let's say, the markets and people are assuming that June 1st is a realistic, let's say, date. So that means essentially that we have pretty kind of tight sort of timeline, right? So I would just kind of to wrap up, I would say the critical thing here is, if you think about what are the options here, right? So of course, I mean, the options are, there are many situations and many scenarios, but I think there's two discussions here. One is if you get a technical default, what does the government do, right? So one option is prioritization. So the government tries to pay only debt, right? Basically to prevent a financial, let's say, earthquake. And the second thing is trying to come up with something that prevents having to, let's say, deal with the debt ceiling, right? Which is, we've heard about the 14th Amendment, which basically says that, you shouldn't question the debt of the United States. And so there's some, conversation that maybe the Democratic side could use this to prevent the having to go to the Senate, although there's a history of about a century or more of debt ceiling increases over the last century. So there's precedent. So maybe the Supreme Court would not accept this. So there's a bit of a, let's say, legal uncertainty as whether that can be used. But potentially what could be used is the 14th Amendment to justify the fact that the government can prioritize payments of debt, meaning they can stop paying Social Security, they can stop paying other social services and prioritize debt because the 14th Amendment says it, right? So that's maybe one of the avenues that we could see. But I guess I've gone too long, so maybe I'll send it back to you, Marcelo, and maybe there's more questions later.
No, that was very clear, and I appreciate. Again, this is something that has been going on for a few weeks, but we also, I think this is a very timely moment for us to go over the live because we're getting closer and closer to the so-called X date, which is not necessarily a fixed date, but when actually the government runs out of money. So then again, very well explained. So I'm understanding, Alejandro, and if you don't mind, if I jump into a very brief question right now, this is not necessarily an economic debate. It's not that the US doesn't have the means to pay. It's mostly a political thing. So it's a tool, as you well said, that the parties use to try to gain leverage to make sure that they get concessions for the other party. Now, the thing is, it's very polarized and it's very divided right now. And we want to see this pressure. We're probably going to see this pressure to increase a little bit before we come up to some sort of agreement, almost like in a chickens game to see who's gonna concede first. Is that fair to say? Like, it's not an economic issue. For now, it's a political issue, right?
Yes, I would agree with that assertion. And I think the market is taking it that way. I think the scenario that the market fears is a technical default, which is basically a situation where some bond is not paid, but temporarily because of this political bickering, but not because of the, let's say, willingness of the government is at question, right? So I think it's well said. And what I would say is probably what we could see in the next few days is we need more pain probably for politicians to be pushed towards a negotiation table, right?
Yeah.
I mean, unfortunately, this has been the historical trend, right? That we need to see some pain before they sit down and close the deal, right?
Yeah, and we're gonna reach the asset class in a second to see that the market hasn't moved that much. So there's not enough pain right now for us to actually get to a conclusion to this. So, Gina, se você não se importa, então estamos discutindo uma questão política.
If you don't mind, Gina, we're discussing a political matter that ends up being a negotiation. There are many interests, not only political interests, but how to do the fiscal management of the country, the US. But in the end, it cascades over the economy. So when we think about the economic scenario and the tax and fiscal scenario, how do we look at it from the viewpoint of private banking and the economy in general? So what does that mean in terms of inflation, fiscal scenarios, and other economic indicators? Hello, Marcelo. Thank you for the invitation. Good afternoon, everyone. As Alejandro said, this is a political matter. When we have the Congress with a majority from a party that is not the same as the president, we have problems like Obama lost control of the Congress 2 years after being elected. In the following 6 years of his administration, and he had to deal with a Congress that was Republican, we had problems with that ceiling, both in 2011 and 2013. Mainly in 2011, the US raised the debt ceiling 2 days before the ex-date, and this led to a downgrading by one of the rating agencies. It was a triple, it was no longer a AAA asset, but there's always an economic aspect behind it. Otherwise, it would be hard for the Republicans to find a reason to discuss the fiscal issue. So I made some slides. I just wanted to show some graphs I think that can be useful for the clarification.
Então, aqui né, então, assim, acho que são 3 coisas que a gente tem que discutir lá, né? Os impactos do não pagamento da dívida, né? O que acontece se a gente tiver
what happens
if
we have a technical default? Some people even think that they may take longer because of the absurd political polarization and the Trump factor. I think it's the main factor of uncertainty. Even if there is an agreement, what will Trump do? Will he attack the agreement? Will be responsible for moving away the Republican vote in the Congress? What will he do? It's like Alejandro said. Today, there is a very tight majority in the House of Representatives and the Senate, and 2 extremes in both parties, both the Democratic and Republican Party, and they won't vote or accept any cuts. So you need to place the debt ceiling in the middle of politicians who are more moderate and not so extreme. But Trump is a factor that can reduce the number of politicians in this middle. So it is a huge political polarization in a scenario of deterioration of public accounts. The US is going through the deterioration of fiscal accounts, and I will show you this situation because there is an increase of spending, especially Social Security and other social spendings and expenditures, but now they need a structural adjustment. And we know, based on our own experience, it's very hard to do, to reform the Social Security system. We took forever to do it in Brazil. It's very complicated. So the Americans are requiring and demanding the increase of the debt ceiling, but the Republicans want to have more cuts while the Democrats want to raise taxes. There is a huge gap between these two positions. I'd like to show this graph to share the impact of what's happening. The worsening of the CDS, which is the risk of default. The CDS in 2011 went up, the same thing in 2013, and now this huge rise of a CDS because the market is then showing that they're concerned with the small likelihood of the United States not paying the debt. Such projections were broadcasted and the Council of Economic Advisors of the President shared this information. This group used economic models and they placed the data and the model, and we know there will be a tax or a fiscal shock if the Treasury stops spending. It's a huge number by paying social costs and providers, so it would be a recessive shock. And the government cannot react because usually the government increases expenditures when it happens, but in this case, the government is causing this shock. So these are numbers that are hard to imagine how exaggerated they are, how accurate they are, how reliable they are. I think there must be a little bit of exaggeration, but it shows that it will cause an effect, especially on employment of companies who will not receive this money and people who will not have the money to spend. And the small default would take about 0.6 from the GDP, but the brinkmanship is this uncertainty that increases and may affect the economy. It's not happening yet, as it's been said. The markets are pretty calm. One of the channels of this brinkmanship would be fall and share prices and a huge reliability deterioration. It's not happening. Everybody's taking into account that this will be solved in the last minute, as it was previously done. So there is a huge potential for damage, but nobody believes it's actually going to happen. After a 1 month default, then we have the protracted default that would have a catastrophic impact. But the United States don't have any problems in funding public debts. People want to buy American titles, American treasuries. So it's a matter of solving this political problem or leaving it on the side, saying that there is a limit for what we can do to solve that. But the Republicans are a part of the party are very extreme, and Trump himself said that if there's no cuts, then we will have to default the debt, which is unthinkable. So political analysts are much more concerned than the market with the potential of what may happen this time because of the Trump factor. But then what would be the problem for the U.S.? Well, they have long-term projections. And the Congress has an agency that makes such projections, the fiscal results for the next 10 years, and this is what they use as a basis for their discussions. And this agency is saying that the fiscal deficit of the U.S. after COVID reached the record low, but it went up to its normal level after stopping these expenditures with COVID, but the trend was the same, strong trend for the deterioration of public deficit, and a lot of it has to do with the rise of the debt size. So the American public debt will go back to the same level, the highest one it has ever reached after World War II, without a war. So I think this is the discussion in the U.S. after World War II, the debt boomed, but there was a war. But now we may reach the same level, 120% of the GDP, without having a war. So fiscal adjustments need to be made because the increase of the cost of the debt has to do with the size of the debt. So there is a deterioration of expenditures
tanto despesas discricionárias como despesas
with discretionary
obrigatórias. Então, quando a gente olha aqui,
or
então a gente vê que os Estados Unidos, a situação fiscal é uma coisa assim, meio bem estável, né? O Brasil, né, que a gente vê nos últimos anos, aí 20 anos, a receita está subindo, a receita ali do governo federal é uma coisa mais ou menos aí ao redor de 18%.
Their income is about 18, 19% of the GDP, and expenditures, there are moments of fiscal adjustments.
Nos anos 2000, aí, ajuste fiscal.
In the years 2000, there was a tax adjustment, and then after COVID, in the 90s as well.
Mas, né, que chegou-se até nesse período aqui a falar que a dívida pública americana ia para zero, porque, né, na época do governo Clinton, não tinha mais déficit nos Estados Unidos.
Zero, because there was no deficit in the state, but then in the end everything went back to normal.
A receita mais ou menos
estável,
so the
baixa, revenue is low, but it's stable.
Se a gente olhar níveis de OCDE, é uma despesa
If we look at the OECD numbers, this is a low level of expenditures,
uma arrecadação baixa do governo,
and also a low tax collections, because usually governments collect more taxes in developed countries, and then an increase of expenditures and interest. So when we break it here, we see an increase for mandatory expenditures such as
precisa fazer ajuste aqui, e o problema é, os
republicanos
querem mexer na linha
the Republicans want to touch this blue line, cutting social costs and increasing the requirements for people to have access to
que o Biden aprovou ali de energia limpa.
unemployment benefits, but the Republicans want, the Democrats want to increase the revenues, to tax the rich, but there's a huge gap between these two groups, and they will have to find a way in between, and the solution for now is to extend the deadline for the debt ceiling for a while. A lot of people are talking about July, September, the end of 23, to give them time to negotiate, and I don't think Joe Biden will not accept some cuts. I think they will, but then they may have a debt ceiling with an inflation adjustment below the current inflation, maybe 1%, and this would cause a huge adjustment
as contas são alguma coisa como $1 trilhão de
of about $1 trillion in 10 years, so it would improve that trajectory I showed you.
O teto lá, é a briga que a gente viu aqui.
It's a similar struggle we saw here, a similar battle. What will we cut within the ceiling? There was a lot of discussions in the US related to defense spending in the US, which means a lot in their budget. Republicans want to increase it or preserve it as it is. So there's room for negotiations, but
vão precisar de mais tempo do que esses dias que a gente está vendo ali até.
I think they will need more time than what
uma solução mais até fácil, só faz o teto ali, depois a gente vê como é que a gente
an easy solution would be, let's set the ceiling and then we'll discuss how to deal with that. So we could extend the debt of the ceiling until the following year, and if there's no agreement,
postergar isso
this could be delayed for 2, 3, 6 months,
acho que essa é a questão fiscal lá,
a more thorough discussion. So this would be the tax problem, I would say, in the US, and this is why they've been discussing this topic, because there's an economic basis in addition to the political discussion. If that would didn't mean a problem, then this political problem wouldn't be that complicated. So the discussion is how to deal with the different beliefs of each party, and this difficulty in reaching a compromise.
Qualquer semelhança, Marcelo, não é coincidência.
Similarities with Brazil are not
semelhança com o Brasil também, né?
Yeah, very similar to our reality.
Você vai gastar mais, tem que aumentar imposto.
If you spend more, you need to raise
então, basicamente, a gente,
taxes.
Se eu peguei bem, Gina, a gente tem 4 cenários, não com prioridades iguais,
We
claro,
have 4 scenarios, not with equal priorities, but we either delay the debt ceiling to try to reach an agreement, so they can keep on discussing, and their estimates from July to November, December. This would be the basic scenario of all consultants. It's more likely.
O gatilho disso seria aí realmente encontrar um acordo no meio do caminho, talvez alguma coisa de teto de gasto, uma resolução, entrar num acordo onde esse abismo que você
midway. So this
dos
gap
dois partidos
between these two parties, they can meet in the middle. Let's cut expenditures, let's discuss things separately. It would be a compromise, and the other 2 alternatives would be more or less orthodox measures, like printing currency, minting a bill. So some has been mentioned, but I think this would affect the reliability and the future management of these choices would be complex, or even the technical default.
Eu acho que assim, calote, eu acho que aquele cenário de
I think that scenario of a default that would take too long, a prolonged default would be not likely, but for some days, like a short default, maybe. And then the market won't react very well, which would force politicians, in my opinion, to do something. But everyone knows who they're dealing with, so you may reach the last minute trying to make what you want, but then if there's no agreement, they will have to reach an agreement. They'll have to or keep on discussing. So how, what happens, technical discussions like Alejandro mentioned, who will receive the payment and what happens to the market. There are so many discussions everywhere about this. Yeah, people are guessing.
Educated guess,
I would say, but let's call it an educated guess because there's a lot of unknown factors depending on the scenario. Yes, because it has a lot of branches. The treasury market is large and liquid. I'll let Alejandro talk about it, but
podem ter repercussões que ninguém pensou.
It may be repercussion, it may have repercussions nobody thought of because they are collateral.
Então assim,
money market funds,
tem uma série de
money market
questões
funds,
que pode ter
and a lot of
uma questão que ninguém pensou.
Maybe there's something nobody thought of.
A expectativa é que chegando mesmo perto do limite,
expectation is that when we're close to the limit, there may be some type of extension. Let's see. If they will postpone.
I'm going to switch back to English. Alejandro, and I know you speak Portuguese, so and you've been talking to Gina quite a lot. But so we have the what, as you mentioned, with the ifs and whens and all of that you described in the beginning of the live. Now, Gina explained to us beautifully how that trickles out into the economy and also the branching out, the possible branching outs, that it becomes kind of a universe. It's very, very hard to predict every single scenario. But now let's move back to investments. So we got situation, we got economic impacts, how we are positioned, how can that affect the markets? And I'm not saying only treasuries and rates, and I would love to hear also your opinion on that, but also on the risky assets, and I'm also going to get Raj's opinion on that. So if you can start debating a little bit of how that's actually impacting the markets and not the economy itself.
Yeah, a great caller from Gina, I agree. I mean, I think in terms of the markets, besides very niche markets, very specific markets, we haven't really seen a lot of reaction to this. So I guess the point here is how much more pain do we need for this to get resolved? I think that's kind of the big question. Regardless of what scenario or what kind of the impact is, but I think we really haven't seen a lot. So the niche markets that I'm talking about is first the short-term bills. So the 1 month treasury bill that doesn't have a coupon, it trades basically on a discount. It's trading about 35 to 40 basis points, almost half a percentage point higher than the 2-month. Essentially because people think, June is the critical date. So if there were to be a default, it would affect the June rather than the July or August treasury bills, right? There's an important technical issue here, which is there's no cross default, let's say, legislation here or regulation, which means if one bond is triggered, it doesn't trigger all the other bonds, right? So that's why this bond is trading differently from the others, right? It's a bond specific default. It's not a curve default, which is important. And that's why the market is reflecting this. The second market that's reflecting, and I think Gina mentioned it already, is the CDS market, the liquid market. CDS is basically an insurance policy against default. It's called the credit default swaps, right? So it's basically an insurance policy. Essentially, you pay to get paid in case something happens. The one that's liquid is the euro. The dollar is not very liquid or pretty much inexistent, and it's trading at around 150 basis points. That doesn't tell you much in terms of what the risk of default is, but the implied risk of default is somewhere around 2.5% to 3%. So it sounds very low, I know, but that's very high for the US. It's not as high as 2011 though, but it is relatively high compared to historical standards. Usually it's nearly zero, right? So 3% means the market has some probability that there could be a technical default. So besides those two markets, we haven't really seen much. If you look at high yield bonds, which are non-investment grade bonds, they haven't really reflected much. I can actually share a chart very quickly to show what I'm saying here. So essentially, what you see is the performance has been very good across the board in terms of the high yield total return. So here it is essentially. So what you see is the performance in 2011, which was the last, let's say, debt ceiling, right? The orange line. This is total return, right? So let's say this level here is 5% total return year to date in 2011. And the blue line is this year, comparing basically what happened in 2011 and this year. And what you see is the blue line is performing very well, right? So high yield is basically up 4%, and it hasn't really been reacting much. It's flat over the last month. What you saw last time around, so the X date is June 1st. So you see this line here, right? For the orange, you see August 1st was the X date for 2011. So what you see, it's interesting, is high yield really reacted very, very aggressively on the date of the X date. I think the reaction here was really because of the fiscal cuts that were pretty aggressive. It didn't trigger a recession, but it triggered a downturn and a risk aversion move. We also have the European crisis, so it's difficult to kind of really know exactly what could happen. But I think the point here is maybe if something happens with risky assets, it could be really close to the X date. And second, that the markets haven't really reacted much yet. So I think the market either thinks this is going to be resolved or is not really paying attention for now until things get a little bit more challenging, I think. So I think that's essentially, I mean, the point here. So in terms of markets, I think we need to see a little bit more pain, unfortunately, right? I mean, politicians are quite relaxed, probably thinking this is not creating the havoc that it did in 2011. There's new members in the House that are a little bit more leaning towards the right, are less educated about markets, so they're probably more likely to get this to the brink. But I think the leaders, both in the House and the Senate, are aware of the situation, and they know that this is probably not the ideal solution. So they're trying to probably come up with something before it turns into something more aggressive. So in terms of, I think another point that's important here is what the impact could be, right? So I think around the technical default, as I mentioned, probably high yield and maybe equities, probably Raj is going to talk about this more in detail, is going to react to this, right? Basically incorporating the risk of something not getting done and at least getting a technical default for a few days. So that probably will hit those risky assets. But I think I think Gina also mentioned this. The treasury market is probably the most important market in the world. It's a collateral for almost every other transactions. You have derivatives, you have repo transactions, you have almost anything, right, in the world. Even currency markets are based off of the treasury curve. And you need collateral, which is, treasury bills, right? So you can have an impact probably in currency markets. The curve basically is the essence to trading currencies, right? Funding in one currency versus the other. which is, essentially an interest rate curve. The second thing that you could see potentially is hedge funds. They're running basis trades. They basically buy, let's say, futures and sell cash, or the other way around, right? They basically trade the difference between the actual bond and the futures. And that has blown up in the past when there's a lot of stress. So that's another thing that could get affected. And finally, I think, because it's collateral, right? You can see clearinghouses getting affected. Maybe clearinghouses forcing people to change one treasury for another, right? Because if that's a treasury that's been defaulted, even if it's for a day or two, they force people to change their securities, right? Or maybe they apply a bigger haircut on that treasury that has been defaulted. So this is the kind of things that we really don't know. There was one instance, though, in 1979, where there was let's say a kind of quasi-technical default, when the treasury couldn't pay a bunch of treasury bills because of an operational issue. There was a debt ceiling issue earlier in the year, though. So there's a bit of comparison of what could happen. And I think we're seeing something similar. The short-term bills traded 60 basis points higher than the other bills when that happened, when the treasury, we're trading now 35, 40 basis points. So essentially, we could see a little bit more pressure if it actually happens and ends up materializing, right? I think in terms of the duration, I think it's extremely important, and I think Gina also alluded to this, that she doesn't think a full-blown default that lasts a long time is very likely. I would agree with her. I think it's more of a technical default, but duration matters for the magnitude of the impact in markets, right? If it's just one day and it's cured quickly, it doesn't matter as much. But if it's a couple of days or a week and you stop seeing social security checks, even defense, I mean, some things that are important are not being paid on time, that's going to have a trickle-down effect in terms of confidence, in terms of the economy, as Gina mentioned. So I think, just a couple of days is less important than it's a week or so, right? So I think duration matters. And I think the spending cuts, Gina also alluded a little bit to this, it's important to come up with some spending cuts because the fiscal situation is challenging. And I think there's kind of some agreement that something has to be done. I think the question is the size, right? And the duration. So the size means how much do I cut now? And the duration is for how long are those cuts in place, right? So there's discussions between 2 years and 10 years. So that's kind of critical too. If it's a cut for 10 years, that's going to have a huge impact on the economy. If it's just 1 year, it's not as important, right? So I think those kind of things will affect markets, especially the treasury market, because that will get incorporated, right? If it's a transitory shock from cutting, that spending, it's not as important if it's a more permanent, like the sequester was, right? The sequester took some, basically across the board spending and for some time, and that's why the markets reacted quite substantially to it. So I think it probably extended it too much, but I think, that's, I hope I made my point. So I go back to you, Marcelo.
No, very, very clear, Alejandro. So I heard two things. No, I heard a bunch of things, but if I can, some things that I want to highlight. The first one is volatility in the short term, especially in the treasury market, should be high. So even the June, or if we see some sort of agreement to delay to, I don't know, July, August, September, whatever the new X date is, we're probably going to see more volatility and a little bit more stressed market, especially for the treasuries. So short term, we haven't seen the impact on risky assets as much, but the solution itself might bring a little bit more. So the pain can come from two different angles. Either the market stop trusting a full resolution, and that actually can push politicians to actually come to an agreement, or the solution itself can also reprice the market and might be paying for as well. So we might see pain coming from two different angles. And one thing that you mentioned to me the other day, I think Gina mentioned as well, the last time in 2011, the let's call it the technical default actually made people to buy long-term treasuries because of the crossover between treasury bills itself. So the safety, it was also treasury, even though the default happened in the short-term treasuries, people ran through long-term treasuries because of that. So treasury was still considered to be the safest asset, kind of safe haven from a protection perspective. Now, if I can move forward, Alejandro, maybe with Gina. So Gina mentioned last live, and we've been having these conversations. We're going through this multi-crisis scenario, right? There's so much stuff going on. We're just touching on we're focusing a little bit on the debt ceiling, but there's also stuff going around, which probably gonna need to have some sort of agreement from a politician perspective. How are we handling this? And you had a lot of, I know IMF, it's been a couple of months, Gina, but how do you perceive this polarization? And we can, of course, we can do it in English, but in Portuguese, how are we perceiving this polarization in terms of handling the other crises that are happening right now as we speak? Either mini crisis or a different kind of crisis because of this polarization. Of course, the debt ceiling discussion it's actually putting a little bit more pressure into this already divided House and Congress.
Eu acho que o debt ceiling é a mais urgente.
Well, I think that the debt ceiling is more urgent.
Essa polarização
it's where this polarization is showing more clearly in politics, but there are problems related to solving important
que não são feitas por causa dessa polarização, né? Eu acho que
that don't have to do with polarization itself. I think it has to do with regional banks, an important problem here, and there has been many discussions that maybe a market solution would be better, like a change in their legislation that would allow more consolidation in the sector.
Maior número de fusões, que se tivesse uma situação ali que reduzisse o número de bancos,
had more mergers, so we would reduce the number of regional banks because of problems with certain banks that are not profitable, and they haven't been profitable for a long time. And political polarization will stop discussions on this because the Democrats has to propose measures that are against what they believe.
E num cenário muito polarizado, então ninguém quer falar
sobre a legislação
bancária nesse cenário.
Nobody wants to talk about bank legislation right now. So there are many things related, for example, to the environmental problems that are not being solved because of such polarization.
Às vezes aumentando o tamanho dos problemas.
This may increase the size of problems because we can't get the right resolution for them. This would be one of the concerns you mentioned of the last meeting of the IMF. There are many important issues taking place at once. They are interconnected, and political consensus would be great to solve them. Actually needed, because they are very important issues. So this is politics, to find a consensus to solve things, but not always they happen. So this is why we're so concerned with these problems.
Da ecologia, né, com a questão geopolítica.
So there is the environmental aspect, the geopolitical aspect. Then it's more complicated
não se consegue, né,
when
e aí, assim,
you can't reach
fala sobre essa questão fiscal, se os Estados Unidos entrar
then when we talk about tax problems,
programa de redução,
let's say the US enters a program
de gastos,
of
né, e amanhã tiver um governo republicano que vai querer reduzir ainda mais
and then tomorrow
as receitas,
a Republican government may want to reduce it even more because they always want to cut taxes. How much more will have to be cut for social costs? And then you enter into a social crisis. You increase the problem instead of decreasing the problem. So it's a real concern.
Não existe common ground, né, como eles chamam,
where there is no common ground related to many aspects, and politics does reflect that very clearly,
para populismo, né, porque populismo geralmente
which opens room for populism, because usually they have easy solutions for hard problems, and this is not how it should be. So debt ceiling, on debt ceiling, the analysts were talking about it since April, and the markets weren't looking at it, but political analysts were very concerned that there was no consensus between both sides.
São visões completamente diferentes de mundo.
These are very different perspectives of the world and how to solve the problems.
Even a little broader, think a little broader in terms of the polarized universe. And I know you're still far away from new election in the US. I'm not trying to bring the US election discussion right now, but do you see that we are closing the gap or increasing this abyss that Gina is mentioning? Do you think we're getting closer to resolutions? I'm not talking specifically about the debt ceiling, but it's just how contentious this whole polarized politics system in the US has become, and whether you see improvement or not. By the way, Alejandro is actually based in the DC. It's not that he's involved with politics, but he's closer, so I'm assuming he's getting things out of osmosis.
So, Marcelo, I would say it's hard to say definitively, but I think there's a space for some common ground. You look at polls and there's things that there's some bipartisan agreement. I think what's difficult is implementation, because politicians cater to their extremes usually, right? I mean, they do social media, but there are things where things are clearly bipartisan, right? I mean, so I think it's a matter of implementation. I think the country's not as divided as politicians seem to show, but the devil is in the details, right? That's I think that's kind of the problem. But I do have 4 points that I wanted to share that I think may help answer this, and maybe we can follow up with more specific questions. I think there's tight margins is a problem, right? I mean, elections have resulted in very tight margins, and elections have, let's say, pollsters have been wrong. So that's creating sort of unpredictability in this sense. There's I'll go into each factor in more detail. The culture versus policy, right? So there's more culture than policy discussions by politicians, right? And that's become also a problem in the US. I don't think the US is exclusively the problem of the US. No. We've seen this in other countries, right? In Brazil and Latin America. There's the technocrats and the politicians, and that's important because central banks have become enormous actors in our economies. And finally, a silver lining, a good, let's say, optimistic tone among this like challenging environment, right? So in terms of tight margins, I think it's, in general, we've seen that legislative and presidential elections in the US are very tight. So the margins don't show that there's a strong mandate to do anything, right? And therefore, there's leverage from the opposition to basically, lever anything they can and make noise and try to kind of take hostage the headlines, right? And I think there's two risks specifically in this situation. One is that even though we have an agreement between Biden and McCarthy, the Speaker of the House, there's only one member of the House can create a vote of no confidence and sabotage basically the leadership of McCarthy, right? That was the cost of him getting elected. So that's one risk. And the second risk, and I think Gina already mentioned this, Trump, right? What if Trump doesn't like the deal and he tries to sabotage this, right? So even though we get a deal, it doesn't mean we're there. We're not out of the woods even when we get a deal, right? Because we need to get through the, say, voting process and no member voting against McCarthy, and he can get voted out in theory. I don't think that's really realistic, but it is a threat for him to try not to be so moderate, right? And the second is Trump, right? Trump might not like the deal and he might make a lot of noise, and negative headlines are probably bad for some re-elections in the near term, right? So I think those are kind of two risks that the tight margins make harder than usual, right? Again, this polarization has existed and we've had debt ceiling debates over the last 40 years. So this is not new, it's just tighter margins make it harder, I think. The culture versus policy is also a problem, I think, because basically the politicians are starting to cater to cultural issues, right? To abortion, to this, to that, the fights with, companies, things that are not related to policy. And what happens is people are not really educated or interested in the policy details, right? And the trade-offs. And this is a very technocratic issue, right? This is specifically about policy issues, about how much do we cut in terms of fiscal spending, what are the consequences, So this is a problem too. I think people are tuned out of this debates, right? They just want culture, showmanship, right, from politicians. And this is catering to the factions, to the left and to the right, right? Abortion, all these things that are kind of outside the purview of policy. The third point is technocrats versus politicians. So technocrats have been very aggressive and very quick to react. We saw this with the banking crisis, right? We saw how the technocrats responded aggressively and very quickly. And we've seen this over and over again. In 2020, we saw technocrats respond very quickly. The central bank responded very quickly. Fortunately, I mean, there were laws approved that basically prevented things from getting worse during COVID. Maybe it was too much, some argue. But the technocrats have been historically, since 2008, very quick, like the whatever it takes from Mario Draghi, right? I mean, this is the example of this technocrats. But governments and politicians take a long time to react. They need to see a lot of pain before they're, basically willing and able to react. And I think this is the typical example, right? The technocrats here can't do much, unfortunately. I mean, what they've done is the Treasury has activated those emergency measures to be able to operate. This is the technocratic side. Now the political side needs to act, and it hasn't. And it's dragging its feet for a month already, right? First, they didn't want to negotiate. Now they kind of want to negotiate, but they're far apart. So we need to see what happens. But I think it's important to see this in this light, right? It's always technocrats versus politicians. And finally, the silver lining, which I think is important, is 2/3 of Americans are worried about the debt ceiling. So even though they're not interested about the nitty-gritty of the policies, they know this is a big deal. And they're very worried, which means eventually politicians will be forced to act, right? If markets moved, people are already worried. So imagine if markets really move, there's going to be a lot of calls to Congress pushing them to move, right? So I think this is a good thing. I mean, people are very worried. And the final thing I think is from the 2011 debt ceiling issue, both parties concluded, I think, most likely, that it was really bad for them. The electorate thought they were basically very, very bad way of negotiating, and they both got negative, let's say, consequences, I think, right? Different timing, different, magnitudes, but I think both parties know this, right? So I think that's kind of the silver lining, that probably this is going to push them to get to some solution at some point. I guess, again, the question is, how much pain do we need, right?
Yeah. And this brings me, we received a few questions. I think it was very complete, but one of the questions, a couple of them actually, we're very close to one of the things that I was going to ask you, Raj, if you don't mind, which is related to the pain. I think 2011, we saw equity markets, a little bit of pain in the equity markets. I think it affects financial condition. I think it's something that it also speaks and the general population can relate to, which is something that you referred right now, Alejandro, like the pressure that the popular opinion has on politicians as well. So, and we mentioned this a couple of times. Gina mentioned we haven't seen that this time yet, at least in terms of equity markets, US, whatever, globally.
Yeah.
So how are you perceiving this? What kind of trigger we can expect? And anything else that we're missing? Maybe earnings will be affected. I don't know how the curve is moving. How are you receiving the equities market in general, Raj?
Yes, I mean, maybe to take a step back in terms of 2011, there was volatility. I think Alejandro had a great chart with high yield. If you look at it, high yield in equities, U.S. high yield and U.S. equities tend to be correlated. So back then you saw similar sell-off in U.S. equities. But again, I think for markets, they need to see that it's a real issue, right? For now, I think equity markets are saying this is kind of a lot of noise, but we don't know. It seems like maybe the negotiations are going well one day, maybe one day it doesn't look like it's going so well. So for equity markets, I think you have a little bit of let's wait to see what actually happens. And when we get to the X date, and if we get to the X date and there's no resolution, then we'll worry about it. Up until then, let's see how this plays out. The other piece, you mentioned earnings. I think the equity markets have benefited from earnings. We just finished earnings season, and earnings beat at a higher percentage than the historical average. So you saw, around a little higher than 6% earnings beat for the quarter. Historical average is around 4 to 5%. So I think that helps markets because you have that as a counterbalance, right? You have the debt ceiling on one side, but then if earnings are coming in better, and maybe the underlying fundamentals from corporate America or globally is doing a little bit better, that kind of offsets that in the short term. Implications, in the future. It depends on what Gina had, right? Gina had some charts on the scenarios, what it could mean for GDP growth, for unemployment rate. That will filter into earnings eventually. Mm-hmm. So, depending on the scenario, what actually happens, it could mean a negative drag for earnings in the future. But again, it goes back to kind of how I started. Markets are waiting, right? Let's see. Maybe we'll be sitting here in a week and they do miraculously come to an agreement. Then it would have been, not worth it to reduce or your equity risk, especially if the underlying fundamentals from companies are actually pretty strong. So I think those are the things that, as it relates to the debt ceiling in terms of what the equity markets is kind of pricing in.
That makes sense. But do you have more upside risk or downside risk from here? Let's say that we come to an agreement. Do you expect US equity market to shoot up, or we have more concern in terms of the other way around? Well, we postpone, maybe the agreement is not as good. I don't know. How are you perceiving the?
Yeah, I mean, look, I think when you think about upside and downside, you think about a risk reward, right? What's the risk and the reward? If we were sitting here and the S&P was at 3,800, I'd say, look, there's a lot more upside because at that valuation level,
41,
at 4,200, the valuation has moved from 16 times earnings to 18 times earnings. So your margin of error, is different, and the risk reward is different. So look, if we get a resolution that there should be upside in equity markets, again, a lot of it depends on the details, because Gina mentioned there could be a fiscal drag, there could be other things that maybe is not great for economic activity, even if there's an agreement. But the downside, if we don't have an agreement with the S&P at 4,200, is probably more meaningful. So again, I think it would be a better setup if the market was at a better valuation level. But when you look at it, the markets are rallied on the better earnings from first quarter, and we'll have to see how this kind of plays out.
Perfect. So uncertainty for the time being, without a lot of volatility, though. We'll see how it plays out. Gina, eu recebi uma, e eu e o Raj, a gente também escutou hoje de manhã no Morning Call.
Gina, Raj and I were listening to the Morning Call, and some investors were asking questions, but now we received a question from a client. Recently, we had a tactic dollar play from the viewpoint of the portfolios. We're short dollar in part of it.
Que é o primeiro nível,
The first level, I would say.
Tivemos toda aquela discussão de
we discussed
mais longo estrutural do dólar,
a longer trend, the structural trend of dollar. It seems there was a pick. We have received some inputs. So we did this movement a month ago, but there was a little rise in the dollar since then. But maybe the debt ceiling discussion and perceive the risk of the US, even in the short run, with all this discussion that we're having now, does that cause an impact on our perspective of the dollar, or do we reinforce that? I think there's no impact in the medium run of a weak dollar, but in the short run, it's impressive. The expectation is that there is such a default. The long treasuries will fall, the interest rates, so they will protect in treasuries, protect themselves in treasuries. So there may be an increase of risk aversion, but every time this happens, dollar is strengthened. So I think it's a short-term movement that won't be sustained when the debt ceiling rises. Everything will be back to normal until the next time it happens. But if it's too serious, then I think it may go against the dollar. The sense that this may happen now. What if it happens again? Let's diversify outside the dollar. So there are many important investors in the US warning about this and what it means in terms of the risk of investing in dollars. We talked a lot about politics, but it reaches a point where politicians have to draw a line and say we can't overcome this. We can't invade this limit. So even Trump may make a lot of noise, but I don't think it will be such a strong attack against them, making it impossible for Republicans to vote for the extension of the debt. But of course, it's a very polarized environment. So I think we continue. When we talk about the dollar trend, we're talking about 10 years. We have interest rates going up and down. Many things happen during this period. And the debt ceiling,
O dólar
when
estava
it happened in 2011, the dollar was
uma tendência de apreciação,
beginning a trend of
Essas coisas de
appreciation.
curto prazo não
So the
são
short
determinantes.
run things are not
uma tendência longa, né?
significant for the dollar.
Tá bom. Alejandro, we still have a few, but just for time's sake, I will ask you one last thing. 10-year treasury is something that we follow up quite closely. Then again, we mentioned the long part of the curve a few times here, how that can be impacted by a technical default or any kind of movement in the treasury market. There's no cross default, but I don't know. You mentioned a bunch of things, but it touched 370 something today, which is kind of in the upper bound of the range. We saw above 4 in the past few months, of course, but for the past few weeks or months, this is the upper part of the range. How are you perceiving the 10-year treasury movements, and what do you think it can be the impacts within this whole discussion of the debt ceiling?
So I think the most likely result, as you mentioned, there's two potential impacts. One is uncertainty, and the second one is fiscal adjustment, right? So both could lead to a rally in the 10-year. Actually, there's been some surveys around asking investors what do they think, and I think the average or the median in terms of the 10-year and the 2-year both go down. I mean, depends on the survey, but in general, I mean, 20, 30 basis points lower, assuming a technical default, right? Of course, 2011 is not a perfect comparison because there were other things. There was the European crisis. There were a bunch of other things happening. So you can't isolate those things. But I would expect that if there's fiscal cuts that are substantial, I mean, sizable, not as big as 2011 maybe, but sizable, there could be some downward pressure on rates. We think, you know, the 325, 375 is a very reasonable range. If you're approaching 375, it means the market is pricing in a soft landing, which is our base case scenario. But I mean, above 375, it starts to make sense to extend some duration. If you're starting to price 325, it means you're probably pricing more sort of a recession. If you're not in a recession, then it doesn't make sense, right? If your base case is not a recession and the market starts to go to 325, then you're probably not better off extending duration. Probably you should shorten duration. So at this point, in essence, bottom line, we're close to 375. We like extending some duration, right? I mean, it makes sense. But to be more forceful, I guess you have to really breach the 375. Right. It also depends on the situation, right? So, but I think here is more upside than downside, if that's probably the question.
We saw in the trading desks, we saw some inflow extending duration for some of our clients and investors' portfolio today. And I think it's part of the reason, it's exactly what I mentioned. So, all right, I still have a few questions, but for time's sake, I just want to say thank you, Raj. Thank you, Alejandro. Obrigado, Gina, mais uma vez. Very instructive. This has been enlightening as usual. I don't think this is the end of it. We're probably going to still be talking about that ceiling for a few weeks or months. But this helps everyone, including our clients, to know where we are right now, how we're thinking, and how we're positioning portfolios and the uncertainty ahead of us. So thank you, guys. See you next time.
Thanks, everyone.
Thank you. Thank you. Bye.
Thank you. Obrigado.
Bye.
Obrigada. Tchau. Boa noite.